Hey everyone, welcome to the KE Report, a daily editorial on Wednesday, September 3rd, with a new guest to the show, Matt Warder. Matt is the publisher of The Coal Trader. You can check out the website and Substack, and also a newly launched podcast. He co hosts the Coal Trader podcast. Now, this is a podcast that I've had the pleasure of helping produce. I've learned a whole lot about the coal sector within this podcast. And quite frankly, it's a sector that I haven't followed that closely. But boy, oh boy, listening to Matt and his partner Joe talk about the coal market and still the growth that they're seeing and some of the the stock moves, it's been impressive. So I wanted to get Matt on the show for some coal content. We don't talk about the coal market that much on the KE report, but that's going to change as I'm going to get Matt and his partner Joe on with me on a more regular basis. So, Matt, let's just start off with a bit of an overview on what you do at the Coal Trader in terms of your newsletter and how you cover the sector. Please give us a little background on you, the sector, and the Coal Trader.
Gotcha. Well, we have, we mostly deliver the mail through Substack, and the service consists of, kind of a daily market update on coking coal specifically, a little bit more periodic update on thermal coal, and then we do, periodic articles, usually about one a week, or sometimes more if there's a lot of news. That's dedicated to, kind of analyzing trends in the coal sector or alternately looking at the equities within them. Separately from that, Substack, we have the coaltrader.com website. And in addition to the same features that you get on the Substack, there are also some, longer history price files, broader overviews of the equities themselves, longer write-ups, those sorts of things. And so it's kind of a two-tier service at the moment. We look to do something I think a little bit more institutional here by year's end, that's more geared toward generalist investment banks and those sorts of folks. But that's kind of in general what the service is. I myself, although I'm specializing in coal, I'm a broader metals and mining analyst. I helped build, my partner Joe Aldina and I helped build Wood Mackenzie's mine by mine coal coverage in the Americas. I later built their coverage for iron ore mines and steel plants in the Americas as well. And then was in a position where I did kind of broader metals and mining research later that covered base metals, precious metals, kind of the battery metals, other more obscure metals markets. I did that in conjunction with Sprott for a little while and legendary resource investor Rick Rule. And so, now I've kind of come full circle and I'm focusing on coal full time, much like I did when I started off my career. But we can as needed, kind of go anywhere and do anything within the sector if it does make sense.
Let's start high level with the coal market because I feel like all I read about is how countries are trying to shift away from coal into cleaner energy sources. But being on and listening to the Coal Trader podcast still sounds like the sector is pretty healthy, if not growing in many areas. So give us that high level overview of the trends you see in the coal market.
Sure. Well, we have to first kind of, qualify the commentary by saying that, there's two different, completely different sectors of coal consumption. One that everybody sort of understands is the power generation sector. We call that thermal coal. The other is actually coal that is used to make coke, metallurgical coke, which is basically like kind of baseball-sized charcoal nuggets. And that is used in the steel industry as both the fuel and the reductant to melt and smelt iron ore into steel. So FeO2, the carbon picks off an oxygen molecule to become molten FeO, and then you tap that out from a blast furnace, blow ozone over top of it to be left with the molten Fe. So, those two sectors of the market have very different demand drivers, right? And, but the thermal coal market is just much bigger, three or four times larger than the global met coal market. So let's start there. The biggest narrative that is driving power demand just in general is the addition of AI data centers. And I'm sure that's come up, in other areas of your podcast, right?
Oh, you know it. Boy, oh boy. And there's that debate of what's going to power these AI data centers. Is it natural gas? Is it uranium? It might be a mix of everything, but sounds like coal is even getting thrown into this.
Yeah, I think we'll try to build natural gas turbines first, but There is a 2 to 3 year wait period if you'd want to order them. And you're going to order them most likely from China or Germany, which now has, if you're in the US, has tariffs slapped on it as well. So the cost of production for power facilities has risen by order of the president here over the past few months. And I think we've kind of, pigeonholed ourselves in a position, at least domestically here in the US, where, where you can't throw a rock in the DC area here where I live without hitting a data center. And demand for power has just skyrocketed. It's pushed power prices, incredibly high. And what people are realizing is that we don't necessarily have enough baseload power generation capacity to address that power demand growth. And so we're going to have to grow, and we're going to have to grow from a baseload perspective. So that can be nuclear, which takes forever to build a plant, or it can be natural gas, which, as I mentioned before, has lead time difficulties on the turbine from a turbine standpoint, or you can build coal plants. And I think what we're going to see first is the unretirement of formerly retired but not yet demolished coal plants. I think that's going to be the first and easiest low-hanging fruit to address these inefficiencies in the power market. But, to your point, this is happening globally. It's not just happening in the US. It's also happening in China. It's happening in Europe. So that is going to limit the availability of coal markets to shrink over the next 5 to 10 years. And that's, I think, an aspect that is underappreciated by many, let's say.
So is China critical too? I know when we talk so much about different metals, different resources and commodities, China always comes up as a key driver, and coal is definitely something that gets brought up when we hear about China and their energy needs. How critical is China? What about other international markets?
China is absolutely critical to it. The interesting thing I think about China is that they have realized that they are going to have to address, climate in a completely different fashion from the Western world. And what they've chose to do, because they do have a lot of coal production domestically, is they chose to transition their vehicle fleet first because they have a command economy. So they're building EVs at a really high clip, and these EVs are going to be powered by primarily coal. And so they're going to, it'll be kind of trading horses for courses from an emissions standpoint. Eventually their demographics will take over and power demand will ease. But they recognize that that's what they have available to them. So that's what they're using in the short term. And demand is growing at a high enough clip that they still have to import certain specs, especially for coastal plants that aren't near the centers of production for China. So they're very important. Population is probably, over 10 years, 20 years, going to limit their ability to grow and consume, a whole lot more coal than they do right now. But it is necessary for them to maintain their appetite for demand for it in the short term while India begins to develop in earnest. And that's what's going to drive the market in future years.
So, Matt, through your research for investors in the sector, how do you lay out the investment thesis? Does it start with the overall coal markets and filter down into the equities, or is it more equity based, then looking at market size?
We kind of go bottom up and then top down. So we analyze the market in both different directions, but both Joe and I came up as cost analysts. So we kind of tend to be costs first, right? And the interesting thing about mining costs is, well, they consume all of these other commodities, right? That's why commodity markets are inherently cyclical, right? The oil that you produce becomes diesel, once it's refined, and then goes into these giant mining trucks that consume it. And let's say you produce iron ore or coking coal with those big trucks. Then that is, refined into, steel at a steel plant, which produces the tube and pipe that then becomes an input cost for drilling and completion at oil and gas E&P companies. So that's part of the reason why when there's a weakness in one part of the energy metals and mining market, it eventually makes its way full circle to everything else. And cyclical commodities like this, well, cyclical things do cyclical things, right? We had a peak in 2022, and we had a big ramp up in 2021 leading up to that, driven by both fiscal spending, by deficit spending, by inflation, by the Russia-Ukraine war. And we're on the other side of that cycle now. Typically for coal, both met and thermal, it kind of moves in about 5 year periods. And we're 2.5 years removed from the peak. So by the transitive property, we should be about 2.5 years from the next peak. And now is a good time to be, to kind of dust off the cobwebs of the market and look for value down here in an area which we think is going to appreciate over the next couple of years.
Okay, this is the one thing that really caught my attention when working on that Cold Trader podcast shows some of the moves in the stocks, even the larger stocks, very leveraged to what's going on in the market and have had some huge runs even over the last 5, 6, 7 years. How should we be viewing the equity landscape of the coal stocks?
Okay, well, we kind of had a double whammy during COVID. We had the COVID lockdowns, which prevented, any commodity demand from creeping through to the end user. And then, in the sense that you push the ball under the water, as soon as supply chains started back up and you let it off, then all commodity prices went to the moon. It just so happens that I'll explain it like this: once coal mines are shut down in the U.S., it's very hard to reopen them. And in the past, the U.S. has been the swing supplier of metallurgical and thermal coal to the world. So when demand increased and major mining centers like Australia and China could not keep up with the rate of change of demand, they turned to the US and we couldn't increase supply in the way that we've been able to in the past. And that's part of the reason that you saw that huge, bubblicious price movement in 21 and 22. Fast forward to now, we've moved back into equilibrium, right? Once the ball comes out of the water, that's the biggest jump, much like inflation. And then over the next few cycles, we've gone, which are annual, we've gone kind of up and down in, had lower highs, lower lows. And now we're kind of scraping off the bottom, which is approaching the level of costs. And when that happens, just like in other commodities, you see mines begin to shut down, or, in coal's case here recently, they've had accidents and they just haven't come back into the market. And once that happens, supply tightens to the point where, again, the market can't swing when demand increases. We should see demand starting to increase both for met and thermal by the time we get into mid 26, early 2027. And that's kind of when we think we'll begin to see the next inflection point. By no coincidence is that 5 years later than 2021, which is when the last cycle really got going.
So when you look at the companies, let's start at the upper end, the largest, the major coal companies. What does that sector look like? Who are some of those companies? Which ones do you follow? What's your outlook for some of those major coal companies?
Sure. Well, this cycle is going to be a little bit different than the last one. The last one was characterized by really extreme movements. Alpha Metallurgical Resources, for instance, went from just a few dollars a share, two or three, to $450 over that period of time. And, that was a confluence of events. Number one was a giant move in small caps in general. The next was a giant move in the commodity. And the latter was the elimination of their debt and the institution of their buyback program, which is still in place. It's just been on pause, during the down part of the cycle when they kind of shifted to defending their balance sheet. That's in the process of reversal at the moment. And I would expect to see them buying back shares. But over the last, the stock has fallen from $450 all the way down to 138. I bottomed out at $100 earlier in the year, and I think we're now in a cycle where we're probably going to see higher lows and higher highs kind of going forward for that. The whole market might founder a bit through early 2026, but going forward, we're kind of optimistic about the prospects. So AMR is a metallurgical coal producing company. The other metallurgical coal producing companies that I think people need to pay attention are Warrior Met Coal, which is ticker HCC. They're growing production into this next cycle. They've gone from sub $40 all the way up to as high as 60 here recently, but past highs of 75 or 80. And they're back down at the $55 level, which is a pretty attractive point to begin to start a longer term position. You have Ramaco Resources, ticker METC. They also have a very interesting rare earth, prospective mine in Wyoming, which has really catapulted the stock. It's been the best performer in the sector, really, of the major producers. up 154% over the past 3 months. But again, mostly driven by the re-rate to a rare earth multiple. And then finally, you have natural resource partners, which is the royalty part of the metallurgical coal world. There's less volatility there. They have some debt, but they will be debt free, if not by the end of this year, at some point in time, I think in 2026. They made it clear they want to return value to shareholders. So I would expect a lot of buybacks and special dividends from their free cash flow going into the future. And, you got to keep in mind they're a check writing company. So there's no real operational risk for them. They just, whatever the price is, they get a percentage of it. So that's on the Met side. And I'll pause there to see if we need to unpack any of that.
Let's unpack some of that in terms of catalysts. What drives these underlying equities? Is it simply a better coal market, or is it changes in their production, different jurisdictional risks? What are some of the catalysts investors need to pay attention to that make these stocks, let's say, outperform the others?
Well, both, right? I mean, I mentioned that Warrior is increasing production into this cycle. They're producing a slightly lower quality material than the benchmark is globally at this new operation, but it's going to be incredibly low cost. They'll be able to make a really good chunk of money off of it. And then as we get into the part of the cycle where prices begin to increase, obviously that will become, more accretive over time. AMR, on the other hand, is increasing production of higher quality coal. So they'll have a little bit of a bump, I think, in the near term in 26 in terms of top line revenue, but they're also lowering their costs. They run continuous miner operations as opposed to the long walls at Warrior, and they've pulled costs all the way from almost $120 down to in the 90s here this past quarter. And I think they're going to go even lower than that. So that's part of the reason why their buyback program restarted. But obviously, everybody will benefit from an increase in the commodity prices, but the individual drivers just are idiosyncratic to the companies themselves. Hope that makes sense.
Yep, absolutely. Fair enough. Do your due diligence one by one, figure out what the drivers are. What about moving on to the other coal market, the other side of the market? There, some of those other companies.
Sure. In the US, let's do that gradually. And let's talk about the hybrids for a second. There's Core Natural Resources, which we think is a really excellent buy down here in the low 70s. We flagged it out when it went sub 60 back in April during the Liberation Day period. But they're also buying back stock. And they're the combination of two companies, Consol, which was one of the oldest coal companies in the US. They had one major asset, which is the Pennsylvania Mining Complex, one of the lowest cost, highest heat thermal coal operations in the world. Also, a portion of it can be sold into the metallurgical coal market. And they merged with Arch Resources, formerly based out of St. Louis. And Arch has a huge thermal coal mine out in the Powder River Basin, which should benefit from higher power prices. They have an exporting thermal coal mine out west as well. And they have two pretty big longwall metallurgical coal mines in northern West Virginia, and one higher quality operation and one kind of lower quality coal operation in central Appalachia and southern West Virginia. So the way that I kind of look at Core is the core business of Core, which is Consol's Pennsylvania Mining Complex, about 25, 26 million tons of production per year that is produced at a cost of about 35 to $36. And markets for that can fetch as high as 60, 70. I mean, the margins on it are just enormous. The Arch side of the piece isn't really generating a whole lot of free cash flow right now, but if met coal prices increase, I view that side of the business as kind of a call option on higher met prices in the future. So, we really like them. And I would be remiss if I didn't mention Peabody Energy as well, BTU. They are also kind of I think they're about 75-25 or 65-35 thermal to met. They are currently in the process of detangling themselves from an acquisition they agreed to make a year and change ago. They agreed to acquire Anglo's coking coal mines in Australia, but there was already one fire at a mine that was not operating, and they've had another one since, and they're either looking for kind of a lower price to complete the transaction, or alternately to get out of it altogether. So, Peabody's value depends on the outcome of that particular event. But, if it doesn't go through, the stock probably goes back to $20. If it does go through, we could go back to lows because they're going to have to take out debt in order to fully finance it. But they like Consol have a big contingent of U.S. thermal coal production that we do think is going to be pretty profitable over this next cycle. And then finally, we have Alliance Resource Partners, ticker ARLP in the U.S. They are primarily domestic thermal coal producers. They have a little bit of Bitcoin exposure. They have a little bit of natural gas exposure from the royalty side. So they're a little bit more diversified than just coal, but their core business, mines coal for about, $36, $37, sells it for 45. And although I think prices are probably going to go down on an annual basis for them a little bit next year, they have this 10% dividend master limited partner structure that yield hounds, I think, would be incredibly interested in. Dividends relatively safe. Markets are at least pretty steady eddy to rising. But that's that's the last one in the U.S. that we cover in depth. It is primarily on the coal side.
So, Matt, just so we don't cover it all in this interview, leave a little bit for our audience to listen to when I bring you back on the show. I would be curious to get into what the smaller scale companies look like, but just a bit of an overview. At the Coal Trader, through your Substack, what sort of trading recommendations do you issue? How do you lead your subscribers through investing in these companies?
Right. Well, because our subscribers range from institutional investors all the way down to retail, their time frames are all incredibly different. So we have to be pretty cognizant about how we talk about them. So mostly my daily commentary is going to be focused on short-term moves. From the equity side, I tend to use some kind of, band indicator, whether that's Bollinger Bands. I personally prefer volatility-based envelopes to call short-term tops and short-term bottoms. Depending on market conditions, stocks may go to the kind of top of the value list as opposed to the bottom. They move around all the time, depending on circumstances. But whenever either an extreme top or an extreme bottom kind of comes into play, we send out alerts that kind of denote to people this is a good time to pick some up. Separate from that, in larger pieces, we talk about broader market trends. So what the 2-year or 3-year outlook for coal looks like. And in those, we talk about the prospectivity of both thermal coal prices and met coal prices, and then individually how that trickles down into the equities. So it's really a two-phase focus, right? We're focused on the longer term for the evolution of the commodity price. That trickles through the equities, but mostly on the equity side, we want to tell people who are, as they become interested, where good short-term buys and short-term sells are, if that makes any sense.
Absolutely. Hey, Matt, like I said, I've learned so much from just working alongside you at that Coal Trader podcast and reading over your material. Such an interesting market and one that's been around for a long time and looks like it's still going to be around for quite a while. And some of those moves in these equities, when I went back over the last few years, have been really astronomical. So interested to follow along for the coal sector with you and maybe even your partner, Joe, bringing him on the show. But for everyone listening, if you want more information on the Coal Trader, click the links in the show notes. I'll post a link to the Substack as well as to the first couple episodes of that Coal Trader podcast. Everyone, have a listen. Send me any questions you have on the Coal Network. I'll get Matt back on the show to address those and give us some updates. Matt, thank you very much for the update. Again, Matt Warder, publisher of the Coal Trader.